All right, so obviously we've got lots going on in the world today over the last several weeks. We've been talking with lots and lots of people, and many are worried, concerned, and even scared about what lies ahead. And there are businesses closing around town and around country. People are being laid off, furloughed, fired, unemployed, whatever you call it. But individuals and businesses are being impacted by what's going on. The unemployment rates across the country are at an all-time high, and I almost feel bad about saying this, but our business is thriving right now. And these uncertain times, when people are scared, when people are losing their jobs, when people are losing more money than they ever thought possible, our business thrives. And I'm in the risk management business. Now, in times like this, people find out that they were taking more risk than they realized, and then maybe their plan isn't doing what they thought it would do. So we help our clients understand the appropriate amount of risk that is right for them. We help our clients with safe money solutions as well as guaranteed income throughout retirement. And we also help our clients with tax efficient planning options, or sometimes help them realize how tax inefficient that their current plan is. And so we're good at what we do, and we've been doing it a long time. And so times like right now in crisis, people beat down our doors just to get some help, and we're thriving when so many are not. So here's what we're going to do. We're going to go through this presentation. It's about maybe 30 minutes or so. And we're going to touch on many topics, very high level. And it must be high level because every plan is different. Every situation is unique. And on the back end of this webinar, you'll have a chance to schedule a 15-minute phone consultation with me. So during this consultation, I'll have a chance to learn a little bit more about you, what's important to you, and what secure retirement looks like for you. And at the same time, you'll have a chance to learn about me, to ask me questions, and also to learn about what we do for our clients. So we will determine together if we think we're a good fit for each other and if it makes sense to begin the virtual process. So for those on the webinar today that do stay throughout the whole thing and schedule the 15-minute phone consult, we're going to give you a $25 gift card, which is our way of giving back. And I'm going to ask that you take the $25 gift card and go out and use it in the community. Which business or a restaurant is near and dear to your heart and who needs your help. So together, let's go ahead and pay it forward. So to the presentation. Okay, so my name is Jason French, and and I'm a registered investment advisor. And I'm also an Operation Enduring Freedom veteran. And I completed enlistment in the Navy right after high school. And then after that, I went on to get my GI Bill at the University of North Florida. And I continued to get my master's degree. So I've got my MBA from University of North Florida. And then after that, I worked at Merrill Lynch, then Edward Jones. But as I grew in my career, I realized that I wanted a more customized service to offer my clients. And French Capital Management was born in 2015. So why are we here? Retirement today has a much different meaning than in previous generations. And we're going to dive into it about the reason why. So let's go over a program we've all heard about, and maybe we don't fully understand what it is. It's a program that's been around since 1935, and yeah, you guessed it, Social Security. There was a huge change to Social Security, though, during the 2015 Bipartisan Budget Act, which drastically affected the timing of when you would start to use your benefits. So Social Security's mission was designed to keep elderly above the poverty line, and it's not a sole source of income, even though it's often used by many people as a sole source of income. Um, so here's a little fun fact about the first recipient of Social Security benefits. So for those of you who don't know, Ida Mae Fuller received the program's first retirement check for $22.54 in the year 1940, which in today's money would be around $400. Which is still not a lot, but she was able to live on that amount up into her later years. Now, here's the interesting thing on why retirement age was at 65, because people were expected to die in their 60s, and people didn't live that much longer after they stopped working. But these days, that's actually a young age, since people are living twice that, twice that length a lot of times. People are just living longer. The actuarial scientists, the actual aerial science behind calculating the original full retirement age date, it factored in the fact that a lot of people had passed away immediately after their working years. Many of the recipients were similar to Ida and had very long lifespans, which the program didn't account for. And now most people reach their full retirement age around the age of 67. And in this slide, we can see what amount you get. So you file as early as 62, but no later than 70. And these percentages reflect their benefits. So the younger you are when you file, and remember the payouts aren't fixed dollar amounts, they're based on coal. 1975, it's averaged 3.69%, and since 2000, it's averaged 2.15%, and in 2020, it's come as far low as 1.6%, so coal is decreasing. Your Social Security wage taxes are applied to incomes up to $137,000, any dollar above that amount. Next, we look at the typical Social Security payments, which in this example, in today's dollars, most couples are living off about $2,531 in Social Security benefits. Now, just ask yourself this: how much money did you need to make last month to live the lifestyle that you're living right now? The answer varies for each person. But if you're someone who still has a mortgage and car payments, that's just a small check each month. So let's talk about the recent change that happened. So recently, the Bipartisan Budget Act of 2015, it accomplished three things. Social Security disability was funded now until 2022. Next was the suspension was changed, and it's no longer available. And that allowed married couples to receive spousal benefits. Spouse to receive spousal benefits without delaying the retirement. That strategy has been eliminated, which goes to show that strategies that work today won't necessarily be around 20 years from now. And finally, the restricted application isn't available for filers who turn full retirement age after January 1st, 2020. It used to be that the spouse receiving a spousal benefit could continue to accrue a benefit in their own earnings record, but that's no longer the case. We can see how sensitive laws are that govern Social Security. They are subject to change. The reason why planning is so important. So let's take a look here at Ron and Nancy. So based on their current age, their monthly benefit, full retirement age, and their life expectancy if their benefits start at age 62. So they can expect a total of almost $1.6 million, but we see their benefits when they start taking the benefits at 75% are based on their expected mortality age. So let's also look at Ron and Nancy if they wait till age 67 to take their full retirement benefits. So Ronald turns on his benefits, and then Nancy, when she turns 67, turns hers on. And then based on their life expectancy after Ronald passes away, we can see her total benefit increase quite a bit. So between the time they started taking benefits at full retirement age, they actually accumulated almost $300,000 more over that shorter period of time since they were taking full retirement age versus taking their benefits at 75% at age 62. Now let's see what happens when they start taking their benefits at age 70. Well, you can see that they've accumulated almost $500,000 more during the time that Ronald started taking Social Security benefits to the time of Nancy's death. And so these slides show us why it's important to look at your Social Security report with your advisor. Now taxation. Let's talk a little bit about taxation. Taxation in retirement is all about maximizing wealth by minimizing taxes. And so I love this next slide. It illustrates the steady increase in national debt since President Richard Nixon took us off the gold standard. Now that the US dollar is considered fiat currency and not backed by any gold, we've got this enormous debt that's snowballed, and the American taxpayer is expected to foot the bill, naturally. So let's take a look at how we're going to do that. Well, of course, through revenue from taxation. Now, you can see that before Reagan's presidency, people were paying close to 90% of their income in taxes, and we've actually gotten pretty spoiled now, as we've had, much more disposable income because we're being taxed less. And also, too, we're a consumer economy, but we still don't save enough, even though we're not being taxed as much. So next, let's talk about taxation and your accounts. Let's especially talk about qualified accounts. So that's your IRAs, your 401ks, your 403bs, your Simple, your SEP, TSP, all programs that defer your taxes until you start taking your money out. Now, there are tax penalties for taking money from these accounts too early. Now also too, this year, the Secure Act of 2020 was passed, which allows you to contribute to your tax-deferred IRA at any age. Also, it increased the required minimum distribution to age 72, which means that you aren't by law required to take minimum distributions until age 72 now. Another thing also too was the stretch IRA was eliminated. It was really a great estate planning tool for passing down IRAs through generations, but that's now gone away. And also, when you're an employee who has a 401k as part of your benefits, unless you change the options that are available to you, you're automatically enrolled at 15%. And there's a push for annuities in qualified plans now, which is a new trend. Now let's talk about the required minimum distribution. Some of you might have heard this before, others not so much. Now, these are how the IRS gets back all those years of tax-deferred savings that you had acquired during that time. The government requires you to pay yourself with RMDs. Now, RMD rules are a result of tax laws. Now, also too, we can see that age 72, age 80, age 90, these numbers right here, this just goes and starts telling you a little bit more about how the percentages work depending on what your age is. Okay. Now, while we're also talking about qualified plans and taxes, let's just talk about taxes in a general broad sense. So I want you to ask yourself, do you think that taxes are going to be higher or lower in the future? Because remember, a couple of slides back, it was up to 90% for the highest income earners. So it's going to depend on the ideology of the people being elected into office. So if people favor higher taxes that hold more seats in the government, then there will most likely be higher taxes, and vice versa. If people that are elected to government seats that don't like high taxes, then legislation won't be passed for higher taxes. So we've got to assume for the worst and hope for the best. So let's assume that taxes have to go up. So we can do nothing. So we've got three options. We can do nothing, or pay later, okay? Or we can use the tax-efficient planning options. So that's your Roth IRAs, traditional IRAs, and also to take advantage of living benefits plans under tax code section 7702, which is also life insurance. Now, we have to, we've also got to look at converting to a Roth IRA. So a lot of you might have heard about converting a Roth into a traditional IRA, but the way that works is, in order to pay taxes at today's rate instead of a possibly higher rate in the future, this is one strategy that you can definitely talk to your advisor about. And so, just some things about converting to a Roth. They may provide a hedge against future tax rate conversions, and taxes are a major concern for retirees. To everybody, actually. So not just retirees, but Roth conversions allow you to pay taxes at today's rate instead of whatever the future rate could be. So it's a really great tool to be able to use. Then another planning option is for living benefits. And so keep in mind, these aren't appropriate for all clients. So you really need to have a financial advisor who can make sure that you're a good fit for these plans. They're generally, the contributions are now tax deferred, gains are locked annually. Then you also can sometimes get principal protection for the life of the contract, and they come with a great feature for critical and long-term care benefits. This helps pay out nursing home fees when you get older, so that way you don't have to be a burden to other friends or family members. Okay, now for all you history buffs out there, you are absolutely going to love this next section that we're going to get into. So let's look at it. So this is the history of bear markets. Of course, we're talking about the stock market. Okay, so the first and second quarters of 2020 have been very volatile so far, as we can see. Everything with coronavirus to the economic impact that happened from that. There's just been a lot going on. 2020 has been a crazy year. So here's a chart that shows a result that shows a loss as a result of the coronavirus. So 31%. Okay, that's a major move in that short period of time, but it's also a major opportunity for a lot of investors. I'm going to tell you why. So we anticipate that there will be a recovery, but how long will that take? So let's look at these numbers right here. Now, we looked at 12 major market dips since 1948. And we see that the average bear market lasts about 10 months, but it can be more or less. So, a lot of a lot of times, few investors have the risk tolerance to emotionally accept a series of losses of 20% plus because you don't like to lose 1%, let alone 20. Okay, but there is some good news though. Okay, so it doesn't take forever to recover your losses, but we do know that's important to remember that if you're going to be receiving income from your retirement, you shouldn't focus on growth. You should focus on growth during what's called your accumulation years. And you want to make sure that the closer that you get to your retirement years, you're properly allocated all that money that you accumulated during that time. If we do have a major market correction like this, that your retirement won't be delayed for very long. So we're going to do something next called the money game, and bear with me here. So this is going to be really fun. So we're going to just go ahead and assume that everyone has $200,000. Okay. Let's say we put that money in the market. Let's say we put our money into the market back when it was really shooting up, and let's be silly. Let's just act like we got a positive 50% return. Woo, that's great. So how much money did you just make? We just made $100,000, right? So how does that feel? Pretty good, right? So we made $100,000 in our $200,000 investment, and we feel great because now we're back up to $300,000. Now, after the big gain, guess what might come next? Yep, you called it. What goes up must come down. So let's be fair. Since we said it went up 50% the first year, let's now say it goes down the second year by 50%. So how much is that? It's not 50% of the money you put in, it's 50% of the current value. So next you lose 150%. So now looking at what we have now, $150,000. Wait a minute though. Plus 50 minus 50, isn't that a zero rate of return, right? How much money did you get? You got $150,000. Now let's look at one more year returns, for example. In the third year, let's assume that you get positive 30% return. So 30% of $150,000 is 45. Add all those together, and we have $195,000. So we started at 200,000. Now we do some math. Plus 50 minus 50 plus 30. Plus 30 divided by 3 years. What's our rate of return? 10. We got a 10% 3-year rate of return. Well, so I thought we start with 200,000, but now I've only got 195,000. And now, isn't that something? Okay, anytime that there's a negative in the mix, averages do not work. So when I hear 10 years of 20, so we should have 200 in this example. Never yield. Okay, that's a very exercise. There could be a big difference. So next we're going to look at an example of what we call the sequence of returns. Okay, so let's look at this. This shows the difference between your loss years at the beginning of our investment time frame versus the end of our time frame. From year 2000 to 2000, start in 2003 and end in 2018. Okay, so why do we do this? And do this? Well, we tack on 2000, 2001, and 2002 at the end So for those who remember, those years were all negative market years. And this is to illustrate, once again, the good years at the end of your accumulation. Since the first 3 years of our period decreased our principal, we were left with less investable asset. Spent our next 15 years trying to recover that. Invested the same $1 million years, performed the same, but with a large, but we also had a larger account value, and we were able to grow then the next 3 years, 2000 through 2002, we'd still be in really good shape, even though the average return is still the same between both returns. Yield, remember those. Okay, and we're going to talk about your, let's talk about the Roth. Does it make sense to convert? What other tax efficient planning do you have? Why it's imperative that you get it right. Okay, you need to know today what you're going to be doing tomorrow. We have to have a plan in place. Now, longevity risks are involved when actually this might sound counterintuitive, but what happens when you have you live because you didn't spend enough time. So you need to accumulate enough in your life to be self-sustaining and not rely on the government or friends and family to help you. More and more people are living longer and longer, and in some cases, years. So how do you invest your money during you saved enough to live on? Used to have programs set up during defined benefit plans. The majority plans today took the place of those pension plans. So you're in charge of your own retirement. And one number up here, if you look at it, so we've only got 7.5% of company pension plans that are defined benefit, which is down 85.4% since 1991. Wow. So what they did was they had those plans set up, but they started moving away from that. So that's why retirement. Okay, so also too, what do we got here? Okay, so we're going to talk about rising healthcare costs. Okay, so what you probably know quite a few people who have a loved one in a nursing home, and you also know how expensive those places can be. Percent of people over 65, and the average nursing 35 days. So you're around 3 years. So how do you today? Decade, we're kind of spoiled. We've had a great bull market the last 10 years, and we're not have a minor correction going on. 10 years ago, you could have said, oh, okay, well, the market's always going to be this great. Well, not necessarily. Portfolio, and also separates, being lucky by getting a good stock pick versus having what we call a well-managed portfolio. You have to know the difference. Can we help you out to see that difference? Yes, we can. What can French Capital Management do for you? There. It's as simple as that. Potential to reach their goals, and we help them financially reach them. That's what we do now. Is you want to definitely reach out and go just to have your tax efficient plan and analysis and schedule your. So here's my contact information on the lower right hand side, and I'm not sure where you saw just start asking me questions. Just say, Jason, I want to get a second opinion. That's what we're there for. So, we must get it right. And also tax efficiency and getting the stress test out of your portfolio. I believe that there's two people that are watching this webinar today. Some are on the call, they're worried and concerned. And you don't know if your money will last. Well, you need help and you need it now. Others on the phone have a plan in place. You're looking for information and education and ultimately maybe to do. You're applaud you for taking. That's the next step. The next step is to schedule, see if we're a good fit for each other. And so if we decide that makes sense to move forward, reality is no. And if either of us at any time, we won't. No harm, no foul. We'll still send over the $25 gift card and do our small part in helping these communities. And we know that you'll love, we know that you love your communities and they're back on their feet. So within an hour, book your 15-minute phone call for your time today. And I look forward to speaking